In today's video, we're breaking down a powerful interview with none other than Tom Lee, co-founder and head of research at Fundstrat Global Advisors. Tom just dropped some huge predictions, including this one: Bitcoin could be worth over $1 million per coin. Yeah, let that sink in. He also had a lot to say about the state of the market, how resilient earnings have been, the evolution of the so-called Magnificent Seven stocks, and why he thinks Apple is about to shock the world with AI, just like they did in 2007 with the iPhone. In a moment, I'll play you the full clip of Tom Lee on CNBC's Squawk Box. But don't go anywhere after that, because I'll be giving you my personal reaction and a detailed breakdown of everything he said, including what I believe it means for smart investors like you. And to top it all off, I'll finish this video with 3 high-potential AI stocks that I think are seriously worth your attention right now. So if you're only watching one investing video today, make sure it's this one. And make sure you watch till the end. I promise you, this is packed with value. Before we jump into it, do me a quick favor, smash that like button so we can hit 1,000 likes on this one. Subscribe if you're new here, share this video with someone who needs to see it, and drop your thoughts down in the comments. I want to hear from you. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. All right, let's hear what Tom Lee had to say.
Tom Lee, Fundstrat Global Advisors, head of research. Probably not coming as a big surprise to you, Tom. You've been saying similar things, but one of the things you're emphasizing today, the most hated V-shape bounce in history, or at least in your young, but getting older life.
Yes, that's right. I think many people, when April happened and we had Tariff Armageddon and the market went into a free fall, investors liquidated because they thought we were entering a recession. But, and as you guys had covered, like the market then staged a V-shaped recovery, which caught many people off guard because they wanted to have a chance to get in. They wanted the stock market to be like a K-shaped or flat line. Instead, it was a V-shaped bounce. And so most investors are underexposed at the moment, and they're trying to look at headlines with a half-empty view. But as you guys know, earnings have actually been really resilient, and I think it tells a very good story.
Yeah, Dow's hasn't been hitting. It has hit a new high, but it hasn't in the recent session. But S&P and NASDAQ continue to do pretty well. So there is also a perception, Tom, that valuations have returned to levels that have people worried, and you are citing an equity-weighted S&P multiple. Explain that.
Yes.
Of what? What's the equity-weighted multiple right now?
Yeah, what we're saying is, instead of someone saying, oh, the MAG is making the market expensive, let's just take the average PE of the S&P of every stock, and it was around 17.6 times in 2019. Now we've had 6 what I call extinction-like events, COVID, the bullwhip supply chain effect, inflation surge, Fed fastest hikes, Trump tariffs, and then, of course, U.S. bombing Iran.
6 of them, yeah, okay.
Yeah, all of them should have wiped out earnings, but the S&P earnings have grown, and yet the equal weight PE is now 16 times. So the market's gotten cheaper in the last 6 years, despite proving they can grow earnings through 6 extinction-level events.
The Mag 7, though, there was a journal article that says there's a real split between the Mag 7, those that are really doing well from AI and those that aren't. And if you look at the stock performances, I think Apple's down something like 16 or 18% over the last year, while you have Microsoft and others that have really taken off. Do you think the Mag 7 stays together, or do we need a new terminology, a new grouping for leadership in the markets?
Yeah. To me, the Mag 7 have become household names. Apple is Apple, and Google is Google, and we know the product and we know the stock. And I think they have really established themselves as consumer and business companies. And for me, Apple has been sort of quietly ready to pounce on AI, but I don't think they need to pay up for any of these models. So I think Apple is going to surprise people.
That's interesting. That's a contrarian viewpoint. People think Apple either is too far behind or just isn't going to be able to get the talent that it wants. It's losing talent, not getting it.
Yeah. I mean, they didn't launch an iPhone until 2007, and mobile phones had been around for 15 years. But when they did enter that market, they completely transformed the marketplace. So to me, I think when they want to play big in AI, and when they do in that moment, I think they will change the game.
Well, so the question, though, is do you think that historically they've been able to do that because it's been a hardware game, largely, and a bit of software? I don't want to say the software is not a huge part of it. But the question is whether you think the LLMs have become so advanced that to get there, you actually either have to buy somebody else to do it, or you can actually catch up. I mean, that's the fundamental question underneath all of this.
Yeah, and it's also possible that LLMs all get so good that they are about the same.
Right.
And then Apple...
It gets commoditized. And
correct. And so then Apple comes in and says, look, we have our safety... Look, we're known for our safety rails, protecting your privacy, optimizing what you want to do, make your life better, and they might come out with a version that really, makes heads spin. So I think that I'm not ruling out Apple just because they're a little late.
What do you make, by the way, there's some speculation over the weekend, some reports about the first real Apple foldable phone this fall. Would you buy a foldable phone?
Yeah, I mean,
Big market in China, by the way. People in China seem to love foldable phones.
I think what I found is when you offer someone a bigger screen size, you're pushing them more towards computing and something much higher capability. And with AI, we might want some of that augmented kind of reality. So maybe the time is right for, a foldable phone. And again,
I'm sorry. We got a minute left after last week in the Genius Act, and you suddenly are. I don't know whether I look at you as Mr. Equity guru or crypto guru. Are you able to do both? You have been. You're going to continue this?
Yes. Fundstrat clients know my goal is to find them good ideas and make them money. And now I want to do that with shareholders. I am dedicated to delivering a great return for anyone who invests in any of our ideas, including whether it was our granny shots, which is outperforming year to date and almost $1.9 billion of AUM after 8 months. And now with BitMine, I am dedicated to really making this one of the best performing stocks.
People need to, we don't have time to go into exactly how that works, but here we are 120 basically on Bitcoin, which you used to say at 70, and that was a 60% move or something that you were forecasting as within the next couple of months, or at least this year. Here we are now, what, 150?
I think the 200 to 250,000 for Bitcoin still makes sense because that would still only value it at 25% of the size of the gold market.
Okay.
So I think digital gold means Bitcoin should be worth over $1 million per Bitcoin, and it could happen in the next few years. But maybe pricing 25% of that, especially with Genius Act, makes sense.
Are you going to, start making comments and recommendations about stablecoins?
Yes. I mean, in a sense, stablecoins are the ChatGPT moment for crypto because businesses like it and consumers are adopting it. And now we see JP Morgan and Citi and getting into the stablecoin market, and the Genius Act, of course.
How would you play that?
Well, Circle is one way because it is, a standout company. They've done really well. But Ethereum is really the way to play stablecoins because the majority of stablecoins are created on Ethereum. It's over 30% of its network fees. And if Scott Bessent's right in it, he says now it's close to a $4 trillion market. That's exponential growth for Ethereum.
Ether has taken off recently. It was down at 1,700 or something like a month ago or 2 months ago.
Yes.
Now it's back almost, 36 or something?
That's right. And I know Mark Newton, our head of technicals, thinks it's 5,000's doable near term, but if you value it similar to Circle, it's more between 10 and 20,000.
You give a rat's patootie about August 1st? Does anything change with that for you?
Well,
a new month.
Yes.
Is that that's what you're gonna? That's your answer? Well, it's a new month. Yeah.
I mean, I think that on the half full, the tariffs are really good for the budget. So, and companies are managing through these now, and they're pretty significant now. And it's not inflation. They're not talking about it as inflation. So that's the half full. But you're right. Maybe August 1st gets pushed again, and that would also be positive.
Right off the top, Tom Lee hits us with one of the boldest claims in the conversation, that this is the most hated V-shaped bounce in modern market history. What he's talking about here is the rapid and unexpected recovery in the markets after the downturn we saw around April, which he refers to as Tariff Armageddon. Investors were spooked, many assumed a recession was inevitable and liquidated their positions, but then, boom, the market bounced back in a classic V-shaped recovery. No gradual rebound, just a sharp fall followed by a sharp rise. And here's the kicker. Most investors missed it. They were waiting on the sidelines for a chance to get in at lower levels. They expected a K-shaped or flatline recovery, something slower. But the market had other plans. So now, a lot of them are underexposed, underweight on equities, and trying to rationalize their caution by focusing on negative headlines. But as Tom points out, earnings have been surprisingly resilient. The story the fundamentals are telling is a lot more bullish than many want to admit. Now let's talk valuations, because that's been one of the biggest concerns among market skeptics lately. Tom flips the narrative on its head by shifting focus away from the Mag 7 tech giants that dominate the cap-weighted S&P 500. Instead, he zooms in on the equal-weighted PE ratio, which averages the price-to-earnings ratio of every stock in the index, regardless of size. What he finds is fascinating. Back in 2019, the average PE ratio was about 17.6x. Fast forward to now, after 6 major shocks, COVID, the supply chain crisis, inflation, Fed rate hikes, Trump tariffs, and even geopolitical tension with Iran, the average equal-weighted PE has actually fallen to 16x. Let that sink in. The market has grown its earnings through all these so-called extinction-level events, and yet valuations on a broad level have become more attractive, not more expensive. Translation? The market isn't as overpriced as many think, if you stop obsessing over just the biggest tech stocks. Speaking of tech giants, let's talk about the Mag 7, Microsoft, Apple, Google, Amazon, Meta, Nvidia, and Tesla, a group that's carried the market for a while now. But even within that group, Tom points out there's divergence. Apple, for example, has lagged, down roughly 16 to 18% over the last year, while others like Microsoft and Nvidia have soared thanks to their aggressive moves in AI. But here's where Tom makes one of his most contrarian and thought-provoking arguments. He's bullish on Apple, not because they're leading the AI race today, but precisely because they're not. He draws a parallel to 2007. Remember, Apple didn't invent the mobile phone. They entered late, but when they did, they transformed the entire industry. Tom believes Apple is quietly preparing its AI move, and when it does finally strike, it could fundamentally shift the AI landscape. He argues that Apple doesn't need to outspend or acquire companies just to catch up. They have the hardware, the software integration, the ecosystem, and most importantly, they have consumer trust around privacy and safety. If AI becomes commoditized, if all LLMs, large language models, become equally powerful, then Apple's edge could be its ability to deliver AI with superior user experience and privacy. Think about that. Apple could completely flip the AI narrative on its head. On a lighter note, Tom is open to the idea of a foldable Apple phone, especially in markets like China where demand is rising. But he's not just hyping a new gadget. His take is more strategic. Foldables could signal a shift toward more powerful mobile computing experiences. With AI and augmented reality becoming more integrated into everyday life, a larger screen might become more than a luxury. It might become a necessity. Again, it ties back to Apple's long game, blending hardware, software, and new interfaces for a more immersive future. Now let's shift gears, because Tom doesn't just talk equities. His crypto takes are just as bold. When asked if he's still leaning into the crypto side of things, he says yes, and he's all in. In fact, his firm's Granny Shots portfolio has nearly $1.9 billion AUM and is outperforming year to date. He's also backing Bitmain, calling it one of the stocks he's most dedicated to making a top performer. And then comes the bombshell. Tom says he still believes Bitcoin can reach $200,000 to $250,000, which would only be about 25% of gold's market cap. His long-term target? Over $1 million per Bitcoin? Let that sink in. He compares Bitcoin to digital gold, and in that framing there's still a ton of room to grow. And if Bitcoin is the gold of the digital age, stablecoins might be the infrastructure. Tom calls stablecoins the ChatGPT moment of crypto. That's how transformational he thinks they are. Businesses are adopting them. Consumers are using them. And now big banks like JP Morgan and Citibank are stepping into the space. He says one of the best ways to play this trend is through Ethereum, because over 30% of Ethereum's network fees come from stablecoin creation. That utility, he believes, gives Ethereum a path to explosive growth, potentially even $10,000 to $20,000 per ETH if valued like a financial platform such as Circle. So what's the takeaway? Tom Lee is telling us, loud and clear, that this market is not as overheated as the headlines suggest. There's hidden value if you look beyond the obvious. He's bullish on Apple's long-term AI strategy. He sees Bitcoin still massively undervalued. He views Ethereum and stablecoins as the future of financial infrastructure, and he's urging investors to stop fighting the market's strength and start positioning for the upside. Whether you agree or not, Tom isn't sitting on the fence. He's making big calls. And history has shown, more often than not, that Tom tends to be ahead of the curve. So if you're still sitting on the sidelines waiting for the market to crash, you might want to consider what he just said. That's it for this breakdown. Let me know in the comments. Do you agree with Tom Lee's take? Is Apple really going to crush it in AI? Will Bitcoin hit $250K? Don't forget to like, subscribe, and hit the bell so you don't miss more deep dives like this. Now let's dive into the 3 high-potential AI stocks to buy now. First up, let's talk about Digital Realty Trust, ticker symbol DLR, the global leader in data center solutions and the backbone of the digital world. While the headlines are often dominated by the latest AI models or the next big chip breakthrough, there's a silent giant working behind the scenes, making all of this possible. That giant is Digital Realty Trust. Every AI breakthrough, every cloud service, every chatbot, every streaming video, and every digital transaction, it all needs a physical home. That's what DLR provides, the secure, high-tech infrastructure that powers the digital economy. Without these data centers, the cloud would just be a dream, and AI would have nowhere to live or grow. Digital Realty owns and operates over 300 state-of-the-art data centers across more than 25 countries, spanning 6 continents. Their facilities are the digital fortresses for tech giants like Meta, Google, Amazon, and countless others. These companies trust DLR to keep their data safe, accessible, and always online no matter where in the world their users are. The rise of AI has unleashed an insatiable demand for computing power. Training large language models, running real-time analytics, and supporting billions of users require massive amounts of energy and space. This is driving explosive growth in the need for advanced data centers, especially those designed for high-density, AI-specific workloads. Building these facilities is a monumental task. It's not just about stacking servers in a room, it requires specialized construction, advanced cooling systems, redundant power supplies, and top-tier security. The costs are enormous, and the technical expertise required is rare. That's why most companies, even the biggest tech names, choose to lease space from specialists like DLR instead of building their own. This creates a massive barrier to entry. DLR's moat isn't just wide, it's deep. The scale, security, and reliability they offer are nearly impossible for newcomers to replicate. Their established reputation and global reach make them the go-to landlord for the world's most demanding digital tenants. As a real estate investment trust, or REIT, DLR is required to pay out at least 90% of its taxable income as dividends. For investors, this means a steady stream of passive income, money in your pocket quarter after quarter. It's a rare combination, exposure to cutting-edge technology, but with the stability and predictability of real estate. Their dividend yield is consistently attractive, offering both growth potential and stability. While tech stocks can be volatile, DLR's business model is built on long-term leases and recurring revenue, making it a favorite among income-focused investors and those looking for a defensive play in the tech sector. DLR isn't standing still. They're actively expanding, building new centers specifically designed for the next generation of AI computing. These aren't just bigger, they're smarter, more energy efficient, and ready to handle the most demanding workloads of tomorrow's digital economy. Their global footprint is a huge advantage. With data centers in every major market, DLR can serve clients wherever they operate, reducing geographic risk and opening up new avenues for growth. This international presence also means they're well-positioned to benefit from the worldwide surge in data creation and AI adoption. Most of DLR's clients sign multi-year leases, often with built-in rent escalations. These long-term contracts with top-tier companies provide predictable recurring revenue streams. For investors, that means less worry about market swings and more confidence in future cash flows. And it's not just tech companies that see the value. Recent partnerships like the $7 billion deal with Blackstone show that some of the world's savviest investors are betting big on DLR's future. These deals bring in fresh capital, fuel expansion, and validate DLR's leadership in the industry. Sustainability is another area where DLR is leading the pack. They're investing heavily in renewable energy, efficient cooling systems, and green building practices. As environmental regulations tighten and clients demand cleaner operations, DLR's commitment to sustainability turns a potential risk into a powerful competitive edge. Reliability is everything in this business. Downtime can cost clients millions, so they're willing to pay a premium for DLR's industry-leading uptime. Their facilities are engineered for resilience with multiple layers of backup systems and around-the-clock monitoring. Despite all this, DLR's stock hasn't seen the same hype as chip makers or AI software companies. That means it could be a hidden gem, a value play for those looking to invest in the AI revolution without paying sky-high prices. Think of it like the gold rush. While everyone else is digging for gold, DLR is selling the digital lodging, providing the essential infrastructure and getting paid no matter which AI app or platform comes out on top. Their business model is built to profit from the entire ecosystem, not just one winner. With a diversified client base that spans industries and geographies, and with the relentless growth in global data creation, DLR is positioned as a foundational investment for anyone looking to ride the AI wave. Their role is only becoming more critical as the world becomes more digital, more connected, and more data-driven. With a market cap sitting just under $60 billion, this REIT plays a vital role in the backbone of the digital economy. In 2024, the company reported revenue of $5.55 billion and net income of $602.49 million. But here's what stands out. Its earnings per share is only 34 cents, giving it a sky-high price-to-earnings ratio of over 520. Now that kind of PE might raise some eyebrows, but it often reflects the nature of REIT accounting or high forward expectations tied to long-term infrastructure demand, especially as AI and cloud computing continue to drive data center growth globally. So if you want exposure to AI's explosive growth but with the stability of real estate and the bonus of reliable dividends, Digital Realty Trust is a must-watch. In the race to build the future, DLR is the landlord collecting rent from every tenant in the digital world. Next up, let's talk about Nvidia, ticker symbol NVDA, the company that's become the beating heart of the AI revolution. If you've heard about the explosion in artificial intelligence from chatbots to self-driving cars, chances are Nvidia is powering it behind the scenes. Their technology is the invisible engine driving the most exciting innovations of our time. Nvidia's graphics processing units, or GPUs, were originally designed for gamers who wanted the best graphics and smoothest gameplay. But over the past decade, these chips have found a new calling. They're now the gold standard for training and running artificial intelligence models all over the world. Whether it's a research lab building the next breakthrough in machine learning, or a tech giant rolling out new AI-powered features, Nvidia's hardware is almost always at the core. The numbers are staggering. Nvidia controls more than 90% of the market for chips used to train AI models, a near monopoly that's almost unheard of in the tech industry. Their dominance isn't just a blip, it's a structural advantage that's been years in the making, and it's only getting stronger as demand for AI accelerates. But what really sets Nvidia apart isn't just their hardware. The secret sauce is their software ecosystem, especially CUDA. CUDA is a programming platform that lets developers tap into the full power of Nvidia's GPUs. It's become the industry standard, and millions of developers worldwide have built their skills and products around it. This creates a powerful lock-in effect. Switching to a competitor isn't just about swapping out a chip, it means rewriting huge amounts of code and retraining entire teams. This software moat is arguably even more powerful than their hardware lead. It's like owning not just the best tools, but also the only instruction manual everyone knows how to use. As a result, Nvidia has built a community and ecosystem that's incredibly hard for rivals to disrupt. The impact of this dominance is clear in their financials. Nvidia's data center division, which sells chips to cloud giants like Amazon, Microsoft, and Google, has seen its revenue skyrocket. These companies are in a race to build out massive AI infrastructure, and they're buying Nvidia hardware by the truckload to do it. Nvidia's growth isn't just hype or speculation, it's right there in the numbers. Quarter after quarter, they've posted record-breaking earnings, blowing past Wall Street's expectations and setting new benchmarks for the entire semiconductor industry. At the helm is CEO Jensen Huang, a true visionary in the tech world. He's led Nvidia through multiple technological revolutions, from gaming to AI, always staying several steps ahead of the competition. Huang's leadership is widely credited with transforming Nvidia from a niche graphics company into a global powerhouse at the center of the AI universe. Of course, with all this success comes a high stock price. Some investors worry about valuation, but Nvidia's forward price-to-earnings ratio is more reasonable than it first appears, especially when you factor in their explosive growth and dominant market position. The company is not just riding a wave, it's building the wave. And the story doesn't end with training AI models. The next big frontier is AI inference, running those trained models in real-world applications, from voice assistants to medical diagnostics. Nvidia is already rolling out specialized chips for this market, positioning itself to capture the next phase of AI growth. What's truly remarkable is that Nvidia isn't just selling chips, they're building a full-stack platform, hardware, software, networking, and even supercomputers. This integrated approach means customers can get everything they need for cutting-edge AI from a single source, making Nvidia indispensable to the industry. This level of integration makes it nearly impossible for competitors to catch up quickly. Even the world's biggest tech companies are finding it tough to match Nvidia's pace, let alone surpass it. the company's head start in both hardware and software is a massive barrier to entry. Nvidia's reach goes far beyond data centers. They're powering the brains of autonomous vehicles, enabling virtual and augmented reality experiences and opening up entirely new markets in robotics, healthcare, and scientific research. The potential applications are almost limitless, and Nvidia is at the forefront of each one. Of course, there are risks. Big tech companies like Apple, Google, and Amazon are developing their own custom AI chips, hoping to reduce their reliance on Nvidia. But for the most demanding and complex workloads, Nvidia's ecosystem remains the go-to choice. Their software, support, and performance keep customers coming back, even as alternatives emerge. Another risk is geopolitical. Nvidia relies on outside foundries like TSMC to manufacture its chips. Any disruption in the global supply chain could impact production, but this is a challenge facing the entire semiconductor industry, not just Nvidia, and the company is actively working to diversify its supply chain. The bottom line? Nvidia is the ultimate pick-and-shovel play for the AI gold rush. With a near monopoly in AI hardware, a software ecosystem that locks in customers, visionary leadership, and multiple avenues for future growth, Nvidia is uniquely positioned to benefit from every stage of the AI revolution. The stock may be volatile in the short term, but the long-term trend is unmistakable. Nvidia is at the very center of the AI universe, shaping the future of technology in ways few companies ever have. Nvidia continues to be the crown jewel of AI momentum. The company now commands a staggering $4.19 trillion market cap, thanks to explosive demand for its AI chips. In 2024 alone, Nvidia pulled in $130.5 billion in revenue and delivered an impressive $72.88 billion in net income. That translates to earnings per share of $3.14 and a PE ratio just under 55, much more grounded compared to Digital Realty. What's more, despite the hype, Nvidia's current share price of $171.38 is actually trading about 12.8% below its fair value estimate of $193.33, suggesting there could still be room for upside even after its massive run. If you're looking to invest in the brains behind artificial intelligence, Nvidia is the name you need to know. Their influence stretches across industries, and their technology is the foundation for the next generation of innovation. Their dominance is real, their growth is happening right now, and their future is just getting started. Nvidia isn't just participating in the AI revolution, they're leading it. In the world of artificial intelligence, Nvidia is selling the essential tools, the picks and shovels, that everyone else needs to build the future. And as AI continues to transform our world, Nvidia's role will only become more central, more critical, and more valuable. Finally, we arrive at Taiwan Semiconductor Manufacturing Company, TSMC, the undisputed titan of the semiconductor world. TSMC isn't just another chip company, it's the beating heart of the global technology ecosystem, quietly powering the devices and innovations that define our modern lives. From its humble beginnings in the late 1980s, TSMC has grown into the world's largest and most advanced semiconductor foundry, a company whose influence stretches across continents and industries. Unlike companies that design their own chips, TSMC specializes in manufacturing them for the world's leading technology giants. Think of names like Nvidia, Apple, and AMD. These are just a few of the hundreds of customers that rely on TSMC's unmatched expertise and precision. Every time you use a smartphone, power up a gaming console, or interact with AI-driven services, there's a good chance TSMC's handiwork is at the core. When it comes to the most advanced chips, those built on processes smaller than 7 nanometers, TSMC's dominance is staggering. The company commands over 90% of this critical market segment, leaving competitors trailing far behind. This isn't just a statistic, it's a testament to TSMC's relentless pursuit of innovation and its ability to execute at a scale few can even imagine. Achieving this technological lead didn't happen overnight. It's the result of decades of focused effort, visionary leadership, and an investment of hundreds of billions of dollars. TSMC's state-of-the-art fabrication plants, known as fabs, are marvels of engineering, where the tiniest details are controlled with atomic precision. Each new generation of chips requires not just new machines but entirely new ways of thinking about physics and materials science. Manufacturing semiconductors is one of the most complex feats in human history. The process involves hundreds of steps, from etching microscopic circuits onto silicon wafers to layering materials just a few atoms thick. TSMC has mastered this art, setting the gold standard for quality, efficiency, and innovation. Their ability to consistently deliver at the cutting edge is what makes them the go-to partner for the world's most demanding tech companies. The sheer scale of TSMC's operations is breathtaking. Their fabs operate around the clock, staffed by thousands of highly skilled engineers and technicians, all working in ultra-clean environments. This scale, combined with their deep expertise, creates a formidable barrier to entry, one that few, if any, competitors can hope to overcome. TSMC's customer base is incredibly diverse, spanning hundreds of companies in virtually every sector touched by technology. From artificial intelligence and high-performance computing to smartphones, automotive electronics, and even emerging fields like quantum computing, TSMC is the silent partner enabling progress across the board. The recent explosion in AI development has only accelerated demand for TSMC's most advanced chips. As companies race to build smarter, faster, and more efficient AI systems, they turn to TSMC for the cutting-edge hardware that makes these breakthroughs possible. The company is at the epicenter of the AI revolution, supplying the brains behind everything from data centers to autonomous vehicles. Financially, TSMC is a powerhouse. The company generates enormous cash flows, boasts a fortress-like balance sheet, and has a long track record of rewarding shareholders through dividends and share buybacks. Its financial strength allows it to invest aggressively in research and development, ensuring it stays ahead of the curve. However, no discussion of TSMC is complete without acknowledging the geopolitical risks. The vast majority of its manufacturing capacity is concentrated in Taiwan, a region that sits at the center of rising tensions between China and the West. Any disruption here could have far-reaching consequences for the global tech supply chain. This ever-present risk is reflected in TSMC's valuation, which remains lower than many of its global peers, despite its technological leadership. For long-term investors, this creates a unique opportunity: the chance to own a world-class company at a relative discount, provided they can stomach the uncertainty. To address these risks, TSMC is making bold moves to diversify its manufacturing footprint. The company is investing billions to build new fabs in the United States and Japan, aiming to reduce its dependence on any single region and ensure the resilience of the global chip supply. Governments around the world are supporting TSMC's expansion, recognizing that a secure and reliable semiconductor supply is now a matter of national security. Subsidies, incentives, and strategic partnerships are all part of the effort to ensure TSMC's continued leadership. Some analysts even point to the silicon shield theory, the idea that TSMC's critical role in the global economy acts as a deterrent to conflict. The world's dependence on TSMC's chips may in fact be one of the strongest arguments for peace and stability in the region. TSM has a market cap of around $1.24 trillion, with financials reported in new Taiwan dollars. In 2024, the company generated revenue of 2.89 trillion TWD and net income of about 1.17 trillion TWD. That works out to earnings per share of 50.50 TWD and a PE ratio of 22.77, indicating a relatively fair valuation for a company with such dominant market share and strategic importance in advanced chip production. Investing in TSMC isn't just a bet on one company, it's a bet on the future of the entire semiconductor industry, and by extension, the future of technology itself. As AI, cloud computing, and smart devices become ever more central to our lives, TSMC's role will only grow. With TSMC, you get a dominant world-class company at a price that reflects both its unmatched technological leadership and the risks it faces. For those willing to look past the headlines, the potential rewards are substantial. The main challenge, of course, remains geopolitical. But for investors with a long-term perspective and a strong stomach for volatility, TSMC offers a rare combination of risk and reward that's hard to find elsewhere in the market. TSMC is the indispensable giant working behind the scenes, forging the future of AI, computing, and digital innovation. Its chips are the invisible engines driving progress in every corner of the digital world. If you want to own the foundation of the digital age, TSMC is not just an option, it's essential. The company's story is still being written, and its impact on the world is only just beginning. There you have it, 3 critical ways to invest in the AI revolution: Digital Realty, Nvidia, and TSM. Each is a pillar of the new AI economy, offering unique growth and stability. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. For exclusive tips and in-depth analysis, join the Stocks Galore Patreon community. Details below. Which AI stock do you think has the most potential for the next decade? Let me know in the comments. Don't forget to like, share, and subscribe for more investing insights. Thanks for watching. See you in the next one.